2020 was certainly an interesting year in the Asia ex-Japan region. How did the final quarter end up and what were the key developments?
Thanks, Duncan. It certainly was a fascinating end to a remarkable year. The markets continued on their strong rally seen in the third quarter of the year, with Asia recording a return of 18.6% over the quarter to December, well above the return seen elsewhere from global equities. And indeed, the return for the calendar year was 25% for Asia. In fact, that was the second best return seen in the region over the last decade. When you consider that the region was down 27% in March, it just highlights what a truly unique period we've been experiencing. Perhaps of more interest, however, was the sharp rotation witnessed during the quarter towards value, which greatly assisted us given the positioning of the portfolio. As you know, markets have been very much herded in a narrow cohort of stocks for many years now, which has created great discrepancies in the markets. Although early days, we saw some very encouraging and strong signs of that rotation contributing to performance.
You mentioned the severe rotation in Q4. What were the catalysts driving this?
On one hand, you had the confirmation of an announcement of an effective vaccine, which has obviously given hope to recovery in earnings as countries begin to inoculate their populations, which should flow through to a recovery in earnings streams. On the other hand, you saw some heightened regulatory risks towards some specific sectors and stocks, which also exposed some of the vulnerabilities that had previously been ignored in those very expensive parts of the market.
You talk about the vaccine and the inoculation. In your view, do you think the Asian region has weathered it better than some of the other regions?
On aggregate, I think that's true, particularly the North Asian markets of China, Taiwan, and South Korea, although clearly the region has been heavily impacted, as has the globe, from the dislocation from COVID. But on balance, Asia has certainly fared better, and it's true to say perhaps came into the downturn in a stronger position given the balance sheet strength we observe across much of the region.
Looking into 2021, how are your portfolios positioned and what are the key assumptions underlying that?
Broadly speaking, the portfolio remains consistently positioned with how it's been for the last 6 to 9 months. That is, we're heavily exposed to those parts of the market where we feel the recovery in earnings is underappreciated with respect to the valuation support that these companies offer, their strong cash flow and attractive dividend yields. Despite the rotation I mentioned earlier, markets remain significantly distorted between those parts that are considered safe or perhaps beneficiaries of COVID and those parts of the market that continue to suffer or where earnings remain uncertain. If I refer to the chart, you can see the record dispersion that exists with respect to the price earnings multiples for those perceived high quality or growth companies compared to the value cohort. Although you can clearly observe some contraction on the slide, it remains very early days with the distortion remaining well above historic levels. Some examples of stocks that have led that rotation include, on one hand, Alibaba, the biggest stock in the region, which has come under significant selling pressure for a variety of reasons, specifically the withdrawal of the Ant IPO, which was scheduled to be the biggest new listing of the year and indeed in history. And secondly, the probe into competitive regulations that exist in the online space in China has heightened some of the risks that were previously not considered relevant in investors' minds or perhaps being ignored. On the other hand, a number of cyclical stocks, including financials, have rebounded quite strongly in anticipation of recovering earnings streams as we move into this year and beyond on the back of an effective COVID vaccine and the global economy moving back into a growth phase.
Given what you've just said about some of the rotation, Geoff, do you believe the narrowness of stocks that have generally driven the rally throughout the region are going to be the same, or do you expect to see that expand a little bit?
Although that's been the case for the last several years, we do think it's highly unlikely it will be so going forward for a number of reasons. In fact, if you refer to the chart, you can see the concentration of the top 5 stocks has moved to a very high level, which we think ultimately is likely to be unsustainable. In addition, if you look at the chart on the right, you can see just how narrow markets have been over the last several years, with barely a third of the stocks outperforming the market over calendar 2020. With economies recovering and earnings improving, we think it's much more likely you'll see a broader participation of stocks performing in the market. And indeed, that's what we saw in the fourth quarter. That makes it much less likely that this narrow cohort of stocks that have driven returns over the last few years will continue to do so going forward.
What are the key risks you're watching as we head into 2021?
Well, experience tells us that it's usually the issues or the risks that no one's talking about that we should be most concerned with. However, ultimately, I think the biggest risk that we face going into this year will be the extent to which we can see a recovery in earnings that will support valuations of share prices, just given how far markets have run.
Having said that, Geoff, when you think about valuation discipline and margin of safety, how are you incorporating or thinking about that with respect to the risks?
It continues to be front of mind in all investment decisions we make. And on that basis, we feel very comfortable indeed that our portfolio is suitably buffered compared to the market by virtue of its strong balance sheet characteristics, scope for growing dividends that we think will continue to be a feature for Asia over many years to come, and the far more modest valuations applied to most of the companies that we own compared to the market overall. And the final comment I would make is that although 2020 was a difficult year for relative performance, we do believe the setup coming into 2021 looks quite encouraging. I've mentioned the favourable valuation dispersions that we think ultimately will be tested this year as people begin to focus on recovering earnings in larger parts of the market. We've seen some vulnerabilities exposed amongst some of the very expensive companies that have perhaps questioned or tested the faith of investors in those stocks. And we think the appetite for Asia will only grow over time as people digest the significant opportunities that continue to exist in this very dynamic region.